What's going on, everybody? My name is Zach Hartley and welcome back to another video. In this one, I'm going to walk you through how I am creating a sample, long-term, all-weather portfolio strategy that was made famous by Ray Dalio. Now, if you don't know who he is or what this portfolio is all about, don't worry, I'm going to explain everything. First off, big thank you to BMO ETFs for sponsoring this video. Now let's dive in. The first question I asked myself was, why build a portfolio like this? And the biggest advantage for me is that it's designed to perform well in all economic environments. Growth, recession, inflation, deflation. I'm talking about all the crazy ups and downs that we are seeing, including right now, driven by trade conflicts, global politics, interest rate uncertainty, recession fears, and the rise of AI. With so many dynamic forces at play, managing this kind of volatility can be incredibly difficult, and that's exactly where the all-weather portfolio can come in by diversifying across different asset classes. Now, the all-weather portfolio was popularized by Ray Dalio, founder of Bridgewater Associates. His key insight was to allocate assets based on risk and not just capital. So instead of splitting $100,000 evenly across sectors, you allocate more to lower risk assets like bonds and less to higher risk ones like stocks. The goal is to hold assets with low correlation to each other. Now, here's the general structure of the all-weather portfolio. It consists of 40% long-term bonds, 15% mid-term bonds, 7.5% gold, 7.5% commodities, and 30% stocks. Rebalanced quarterly or annually, it is designed for investors seeking steady growth with a balanced approach to risk. Bonds help to mitigate volatility, gold and commodities act as diversifiers, and stocks provide growth potential. Now, I'm going to be using BMO ETFs to build my sample portfolio, but you can use whatever works for you. I like BMO because they offer over 180 different ETFs to choose from. They were the first Canadian bank to even offer ETFs in Canada, and they have over 15 years of experience. Their fees and liquidity are also very competitive within the industry. If you want to learn more, I will put a link in the description. Now, let's get into building this sample portfolio. Now, the first position I'm looking at is the stocks, which is usually everyone's favorite. This will make up about a third of the portfolio, and to get this exposure, I'm using the BMO All Equity ETF, ticker symbol ZEQT. This ETF gives me global exposure, meaning it invests in companies from all over the world. The management fee is only 0.15%, and my thinking here is that this is the part that is going to be the growth engine of the portfolio. It is designed to capture that growth potential when markets are strong. Now, next is the biggest piece of my portfolio. This is going to make up about 2/5, and that is going to be the long-term treasury bonds. This is really going to be the core and the foundation of the portfolio, and for this, I'm buying the BMO Long Federal Bond Index ETF. Ticker symbol ZFL, and again, do your own homework and you can choose whichever one you would like. This one though, it holds bonds with a 10-year maturity and has a 0.2% fee. In downturns or deflationary periods, this part can act as a ballast, helping to reduce the volatility and potentially increase in value as investors seek safety. Now, I'm also going to be adding an intermediate position, which will be a smaller portion of the portfolio, into medium or intermediate term treasury bonds. For this, I'm using the BMO Mid Federal Bond Index ETF, ticker symbol ZFM. These bonds mature in 5 to 10 years and have a 0.2% fee again. They add stability and liquidity, which is useful if I need to make changes or rebalance. After that, I'm moving on to the alternative asset classes. First, there's gold. This is an exciting one for me, especially since gold has done so well over the last year. Now, to get exposure to gold, I'm going to be buying the BMO Gold Bullion ETF. BMO has several options, but this one is the simplest because it's designed to track the price of physical gold bullion. The ticker symbol is ZGLD, and the management fee again is 0.2%. Now, the biggest advantage to me is that gold is known to be a great hedge against inflation and currency devaluation. As governments print money and as the value of the dollar loses its purchasing power, the value of gold has historically gone up. So in those kinds of market conditions, gold is the part of my portfolio that could provide significant value. Now, finally, I am looking at adding commodities. I had a couple of different options to go with here, but I've decided to go with the BMO Equal Weight Global Base Metals Hedge to Canadian Index ETF, ticker symbol ZMT. My reasoning is that this ETF invests in the companies that produce the base metals our entire economy runs on. The management fee is a respectable 0.55%, and I see this as a way to potentially protect my portfolio against inflation and supply shocks. If global conflicts cut off supply chains or a shipping canal gets clogged, these are the kinds of companies that may stand to benefit from rising prices. Now, here are my final thoughts. What I really like about this sample portfolio is how each piece is designed to do well in different market conditions. It's super diversified so that if the stock market's booming, my equity position has the potential to grow. If it's crashing, my bond holdings can help stabilize things. And if there's a global turmoil or inflation, that's where gold and commodities really come in as key diversifiers. The whole idea here is to build something that can weather all kinds of markets. It's probably never going to be the top performer in any one specific scenario, but over the long term, it's built to help me stay the course and avoid making emotional decisions when things get rocky. Plus, it's super low cost. All of these ETFs have very competitive fees, which is a big win for long-term investors. The only real downside I see is that the heavy bond allocation might limit upside in a strong bull market. But that's the trade-off that we take for stability. Now, just as a reminder, this is a sample portfolio for educational purposes only. It's not investment advice, and it's definitely not a one-size-fits-all strategy. Everyone's situation is different, so make sure you're thinking about your own investment objectives, your risk profile, and what's happening in the market before making any investment decisions. Now, that's it for this video. I hope it gave you some insights into how you can use ETFs to build a well-diversified portfolio for the long term. If you want to learn more about BMO ETFs, I will drop a link in the description below.